Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Hello everybody, this is Noah Davidson with TackleTrading.com, and I have a really important and brief lesson for you that I think is just vitally important. So the other day I came across a clever little cartoon that one of my friends' mentors posted on Facebook, and it made me laugh because it's pretty funny little picture. It's got what looks like some abstract art. One of the pictures refers to the bulls, obviously with the stock market, and the other one refers to the bears, and has these two little lines that to somebody who did not understand much about trading and investing, which unfortunately is too many people, they wouldn't get the joke. Now, if you don't understand this cartoon, that's a problem, because everybody who cares about their money should. They need to. If you have a 401k, if you have an IRA or an RSP, if you own mutual funds, if you own any stocks, and if you own any bonds, and if you own precious metals or any commodities, these things are vitally important. And if you don't know these things, and it's the lack of knowledge or fear that has kept you from actively trading and investing, would you be more likely to invest if you felt more confident about what you were doing? Now, many people think that the stock market is incredibly risky. And the thing that I think is very ironic is that there really is no other place in the world where you can control your risk as well as you can in the financial markets. Where risk occurs is when you don't keep control. So if you have trusted your money to somebody else, or you've put your money into a well-diversified portfolio of mutual funds, or you have your entire nest egg in that 401k, which is then meted out into those different mutual funds, and you start to break down and understand it, you are not in control of your money. And you don't understand the things that I'm talking about. And if you didn't get the cartoon on the beginning, that should be a little disconcerting to you, because your money is at risk, and a fool and his money are soon parted. Now, I'm going to give you a real quick basic lesson about the bulls and the bears on Wall Street. You've probably heard of these names before, and it's not like it's rocket science. But if you actually understand why they call the bulls, the people who believe that the market's going to go up, the bulls, is because a bull will come when it charges its foe. It'll come in and it'll use an upward thrust, its power, with a very powerful upward thrust. And bears will subdue their prey, and they will come down and they will pin them down. So in the market, the mascots, the bulls and the bears, are what they have adopted. And if you've ever wondered why you have the Chicago Bulls and the Chicago Bears, well, the answer is that Chicago is a big financial center, one of the largest financial centers in the world, where the commodities markets and the options markets are. And that's a pretty natural fit. So if we move forward and work on understanding what those mean, and when we talk about bulls, those are the people who obviously want the market to go up. Now, bulls believe that the price of an investment will go higher. Purchasing the financial asset could yield a profit if their bias is correct. Now, risk of loss would occur if the price went down below their purchase price. So, in short, bulls believe the market is going up. Now, an example of this would be Starbucks stock, for example. If you bought it at 50, which it was recently at, and the price rose to 53.63, you would have a profit of $3.62. So you make money on that price moving up. And if you picked up 100 shares of it at 50, well, then you would have a $362 profit. If you bought 1,000 shares of it, well, then you would have a $3,620 profit. This is the part people don't seem to have a problem understanding. Where they tend to have a problem is trying to understand how people make money when the markets go down. Now, a bear believes that the price of a stock or an financial instrument, is going to go lower, and that selling the stock would yield a profit if their bias is correct. So they sell the stock to get paid. The risk of loss occurs if the price instead actually rises above their original price they sell it for. Now, how does that work? How do you sell a stock you don't own? And I'm going to explain the short selling process very, very quickly. The first thing we actually do is we borrow the stock from the broker. and they simply lend it to us. We sell the stock in the market and we get paid. We have a credit that comes into our account. Now, we owe the broker the stock, and when you sell short, you are obliged at some point in time to buy back the stock and return it to the broker. So when you buy back the stock, it's automatically going to get returned to the broker, and then they return the stock to the person who originally owned it. And that's 4 steps. So you borrow, sell, buy, return, but it's accomplished in just 2 simple clicks. And again, it's one of those things where people will say, well, I don't think I really quite understand this. Here's a couple of examples for you to help you understand. Here's an example of American Airlines. Now, the stock recently went down, and if you had sold it at 46 by simply borrowing it from the broker and selling it in the market, you got paid $46 a share, and it dropped to the current price of $40 a share, you would have a $6 profit. And you would have a nice $600 profit if you used 100 shares. You'd have 1,000 shares, you'd have a $6,000 profit. So again, you can make money on a stock when it drops. Now here's an example to help you relate that. You've all seen an infomercial or two, and I'm wagering that you've probably bought something you saw in an infomercial. Now the infomercial model is exactly like selling a stock short. So if you saw the commercial for ShamWow, and the ShamWow people sold you that product for $19.95 plus shipping and handling, and you call them up and you give them your credit card right away, they always say, please allow 6 to 8 weeks for shipping and handling. 6 to 8 weeks? Why on earth would it take 6 to 8 weeks? You could send it U.S. Post ground and it would get there in a week. I mean, my grandmother could deliver that in her walker faster than that. If the product originally cost $4.95 from the manufacturer, and they sold the product to you in advance for $19.95, well, they have your $19.95 in their pocket. They then purchase the product, which they don't own. They don't actually have it yet. They buy it from the manufacturer for the $4.95, and they have a $15 profit. You paid for the shipping and handling, and in 6 to 8 weeks, you are a happy customer because they do deliver the product. But initially, they sold you the product they actually didn't have. Now, you don't have a problem with this as long as the ShamWow shows up. Now, you can go and see the exact same product with the sticker on the box as seen on TV. You can go down to the big box mart, and you can go buy it for the same $19.95. But the difference here is the order of operation. We're very accustomed to going to big box mart, and they already bought the product at $4.95. They shipped it to their warehouse. They then put it on the shelves on display. They got the sticker on the box that says as seen on TV, and they still marked it up to $19.95. They have the exact same $15 profit margin. The only difference is they bought first, sold second, whereas the short sellers sold first, bought second. So that's just a different order. Now, in today's fast-paced markets, there's always money to be made. Markets go up, markets go down, markets go sideways. There's always stocks moving up, always stocks moving down, always stocks moving sideways. But the markets are highly correlated. 80% of all stocks end up moving the same direction. And I'll tell you what does not work as a form of defensive or conservative investing. Diversified portfolios of mutual funds. They don't work. Diversification is not effective. By picking stocks in different sectors, that'll be fine as long as the markets are going up. But when the markets go down, doesn't matter what sector you're in, they all go down. You're going to get crushed. And if you don't know that, that's a problem. Now, I bring you back to that picture. Do you understand what this little cartoon is showing us? Well, again, if you don't, that means your money is at risk. That means you have no idea how to protect yourself in a down market. These are called P&L graphs or risk graphs. And people who understand trading and investing are very, very comfortable and familiar with profit and loss graphs. They are how they control and measure their risk, and they actually measure the positions of a stock or an option position or whatever it is that they're trading or investing in. They display the potential risk and reward, and I would like to be able to show those to you now. Now, the secret to making untold fortunes in the stock market is to actually understand managing risk. You see, it's not so much about the stocks you pick, and it's not so much about whether your bias for being bullish or bearish is correct. It's about how well you manage the risk, because winning is inevitable. and so is losing. And the key to consistently making money and to growing a fortune is to simply manage the risk and to get in the game. So here is a basic profit and loss graph, or a risk graph, for a long stock position, a bullish stock position. If you bought 100 shares of the stock at $50, that is your break-even point. $50 is break-even, which is what we actually have right here, noted on that. Now let me explain this graph's anatomy. Down here at the bottom is the stock's price: $45, $46, $47, $49, $50, $51, $52, $53, and so forth. Over here is profit and losses: $0 break even, and a $100 profit, $200 profit, $300 profit, $400 profit, so on and so forth. Minus $100, minus $200, minus $300, so on and so forth. So if you bought the stock at 50 and you sold it at 50, you're break even. You're at $0. And so the graph at $0, that's break even point. Now, if you buy the stock at 50 and the price rises, you'll have a profit. But if you buy the stock at 50 and the price falls, you have risks. So that's where we get the profit and loss. Now, when we look at a profit and loss graph, the way the graph works is super simple. If the stock rose from 50 to 51 and you had 100 shares, that would be a $100 profit. If you had 1,000 shares, that would be a $1,000 profit. If it rose to 52, you'd have a $200 profit on 100 shares. If you had 1,000 shares, that would be a $2,000 profit, so on and so forth. If it rose to 53, you would have a $300 profit, and if you had 1,000 shares, you would have a $3,000 profit. Now, on the converse side, if it broke down and went to 49, you'd have a $100 loss on 100 shares, a $1,000 loss on 1,000 shares. You get to control and choose how many shares you buy, so your graph would dictate exactly what your profit and loss would be. If the stock dropped to 48 and you had 100 shares, you would be down $2, and you would be down $200. You would have to go back up to 50 for you to break even. And if it were to drop to 47, you'd be down $300. So that's how a basic profit and loss graph works, and that's what was depicted in the cartoon. Now, the bearish posture is the exact opposite, because you borrowed the shares and you're actually sold them, and so your posture in the market's actually negative, and I'll show you that in a moment so you can see it. A bearish posture, you borrow the stock, you sell it at 50, and you get paid 50. So how much do you have in your pocket? 50. And if you sold 100 shares, you have $5,000. If you sold 1,000 shares, you have $50,000. Now, if the stock then fell to 49, you have a $1 gain because you could buy it back for 49, but you have $50 in your pocket. If it dropped to 48, you would have a $200 profit on 100 shares because you could buy it back for 48, but you sold it for 50. So you would have $2 in your pocket times 100 shares. If it dropped to 47, you would have a $300 profit, so on and so forth. If it rose to 51, you only have $50 in your pocket, and so you'd have to go to the other part of your account and pull $1 out and use it to pay for the stock to buy it back. It would cost you more, so you'd be down 100. If it went to 52, you'd need $2 to cover the difference. And if it went to 53, you'd need $3 to cover the difference. And understanding that risk and reward is vitally important. So it's relatively simple in general. And as long as you understand how those risk graphs work, you can make smarter decisions in the market. Now, let me take a minute to just go show you how that would look. And here's a trading account. And I actually popped open here a little virtual trading account just to show you how that works. And let's say, for example, I wanted to go buy stock in Ulta Salons. Oops, ticker symbol ULTA. Whoops, get the right symbol in there, ULTA. And it costs $100 and something a share, and it's currently in an uptrend. It's a nice little stock. It's actually one my daughter picked for me. Good looking stock chart. Let me go grab that here. So it's currently trending up at 156, and I believe that the price is going to continue to ride up, assuming the market continues to rise up. And it's been trading around 156. So if you went and bought 156 shares, and we went and purchased it at 156, and the price then rose, we would be plus 100 shares, and we would get paid if it rose. And if we actually did put that onto a risk graph, we could actually throw that onto a risk graph, and you can actually come and see it. And I actually happen to already have a nice little trade on there, but that's what that trade would look like. The break-even point, $0, would be right there at the price you paid for it, $56.50. If it rose to 165, you would have a nice little profit at about 850 bucks. If it fell down to 150, you would have a drawdown of around 660, 50 bucks, somewhere in that ballpark. So that's how the graph works, relatively simple. Now, a short seller, a bear, let's say I wanted to sell Walmart, speaking of big box mart, Walmart short, and the market is currently heading south, and Walmart happens to be in a downward trend, and it's currently in a place where the old price floor could become a new price ceiling, and a good chart technician would see this as an opportunity to sell it short, and it's currently going for $71 a share. Well, if I think it's going to drop down, and I actually project this thing dropping down towards 68, 66 in the near future, I could make a quick buck by simply selling it. Now, how do I sell something I don't own? The first step was to borrow it. You'll notice over here it's got this little thing that says ETB. And when I point to that, it says, oh, it's easy to borrow. So when I go to sell the stock, all I do is click on the bid price, and it opens up a sell ticket. And I'll open up a trade for negative 100 shares. And if I were to click that trade and send it in, I would get paid the price I asked for, the $70.83 in this particular case, which is about the bid price. I could probably ask for $70.85 and probably get filled there, no problem. Now, if we were to go analyze that trade and go look at it on a risk profile, what you'll see here is that the break-even price is what you sold it for. And if the stock price dropped down to, I think it's going to drop to 68, or down to 65 even, you'd have a nice little gain if it dropped down to 65. But if we were wrong and the stock price rose, we could exit the trade at any time. But if it rose to, say, 75, you'd draw down $400. You'd owe more than you sold it for. So you would have to cover the difference because, remember, you borrowed the shares. And so the broker charges you a little bit of interest for borrowing the shares, but the stock belongs to some other Joe who owns the stock and is sitting on it and holding it and has been holding it for long term because they were taught to buy and hold. So that's essentially a basic introduction to selling short. Now, why is this so important right now, and why did I actually decide to make this video? It has to do with this. The greatest stock market crash in history is coming soon. And it's not really a question of if, it's simply a question of when. We have a global debt crisis. The problem's global and it's systemic, and I'll make another video on that. But the Fed has been stress testing banks for a 60% stock market correction, and they're estimating oil prices up at around $110 a barrel. And many, many experts agree that the next major market correction will be the biggest in history. It's going to be bigger than the crash of '29 before the Depression, the crash of 1987, the crash of 2001, the crash of 2007. And the reason being that it's so important is because if your money is tied up in the market in your 401k or your IRA or your mutual funds, bonds are going to get crushed. The dollar potentially could get crushed because we may be looking at currency issues as if we see banks fail. You can see the problems in Greece right now as just an example. Global currencies, your savings are suspect because if they end up having to print money to get us out of this problem, that absolutely crushes you. Banks could fail. During the last market meltdown, 700 regional banks failed and credit markets almost seized. And if all of those things go south, what happens next is it starts to hit the job market. And so if you are not protected and you are not prepared, and all of your money is sitting in a 401k, you are about to get your assets handed to you. And this is a warning for you. Now, I certainly hope the market doesn't crash, but when you understand the markets like the professionals do, and as I have been studying for the last 15 years, it's almost a foregone conclusion. And the reason it's going to be one of the biggest crashes ever is because the traditional methods they use to help prop the market up are gone. They don't have that ability right now. And again, people are taught to trust in the markets long term, that in the long term they'll go up, but we are running into and we're headed into a really big problem. And the problem really stems with the fact that we have 78 million baby boomers in the United States, and globally there's, I don't even know how many millions of baby boomers we have in Europe and in Japan, et cetera, et cetera. They're all heading into retirement. They're all going to be pulling their money out of the market. And population has shifted, and we don't have as many people putting money into the market. And we have massive global debt problems, government debt, sovereign debt. We have, the U.S. government's in $18.2 trillion worth of debt, and they have $128 trillion of unfunded debt obligations. And it is a big setup for the perfect storm. Now, this is a chart of the current S&P index as of today. And this is the high back in 1999 before 2000 crash, and we saw it drop from around 1500 to 800. That's about a 50% correction. And we saw it again come to the same highs, or just shy of 1600 in 2007 before the subprime meltdown, and it crashed and it went a little bit lower down to 666. And that was again pretty darn close to about we've got just 40% correction. The experts are projecting a 60% correction, and we're sitting out here at 2077. Now the market's showing signs of slowing down, and sure, it could rise, and it may not be this year, it might be next year, it might be 2 years from now. I don't know that, but I do know that on average market crashes begin and they start in September and October, and those are the months that the market can get hit hardest. And right now the stock market has been propped up. They've been stimulating this and been propping it up, and we're in a bubble. And when you see the little body language of the market actually doing this little pattern right here, where you see the top of it slow down, and you see that top of it slow down, and you see the top of it slow down like that, we start to suspect that it's getting ready to turn. And if it does drop, we could start to see a significant drop, and it usually takes a little bit of time for it to net out. But if your money is sitting out there in a 401k or in IRAs or in mutual funds, what happens is the bears will sell short, and your stock will devalue, and the money that you lose goes into their accounts. So this is going to be potentially devastating to the masses, and those who know what they're doing have a huge opportunity to get rich. Because remember, a fool and his money are soon parted. And if you are not in control of your money, who is? And if you're not protecting your money, what is your game plan? And I think that this is vitally important for everybody to understand. That's why I made this video. So if you like this and you want to learn more about it, come visit us over at tackletrading.com. I'll be making more videos in the coming weeks to help you understand basic market principles, because at the end of the day, it's not rocket science. And if you understood what I was talking about here and I made it easy, that means that you would have no problem learning how to control your own money. And I will make a video showing you how you can absolutely beat the snot out of every mutual fund out there with very, very simple strategies that anybody can do. And I can show you how to outperform the way you've got your money set up, and you'll start to figure out very, very quickly that the match from your contribution to your 401k gets completely eaten up in all the fees and management fees and everything else that they're giving you. And at the end of the day, you'd be better off just taking the money and managing it and putting it yourself into a self-directed IRA, and to get the tax benefits that way. And I'll make a separate video for that. Again, this is Noah Davidson, Coach D with tackletrading.com, and we'd love to have you over there with us learning how to control your own money, get in the game.
Isn't it time you got off the sidelines and tackled trading? Join our online community of active traders where we make it happen every day. Stocks, options, futures, and Forex at www.tackletrading.com. Get in the game.